Last time your banking app asked you to update your income, did you ever stop and ask why? Because here's the thing, most of the time they don't actually need that number. You know, the pop up. Friendly tone, pre filled box with your old income already sitting there. Update your income to help us serve you better. Takes 10 seconds to fill in. And almost nobody pauses long enough to ask the obvious question: serve you better or serve them better? My name is Dave, and I love helping people see what's actually happening behind the friendly interface every time an institution asks for something they don't strictly need. Today, we're talking about your income number specifically, why banks and card issuers keep asking for it, what they actually do with it once they have it, and the very real difference between the situations where you have to share it and the situations where sharing it is just doing them a favor you never had to do. Let's start with something that should genuinely surprise you. In most cases, banks are not required to ask for your income. There's no federal law saying a credit card company has to know your salary to keep an account open. There's no rule forcing your bank to maintain an updated income figure on file for an account that's already approved and sitting there working fine. They ask because the information is useful to them, not because they're legally obligated to collect it. That distinction changes everything about how you should treat the request. When something is legally required, you genuinely don't have a choice. Mortgage lenders are a good example. They're required under federal lending law, specifically the rule that came out after the 2008 financial crisis, called the Ability to Repay Rule, which is exactly what it sounds like. A rule that says lenders have to actually confirm you can afford the loan before handing it to you. That requirement exists because before 2008, plenty of lenders weren't checking. And that's a meaningful part of how the crisis happened in the first place. You'll provide pay stubs, tax returns, employment verification. There's no getting around it, and you genuinely wouldn't want to because that verification protects you as much as it protects them. But a periodic income update pop up on a credit card you've held for 3 years, that's a request, not a requirement. And that difference is the entire subject of this video. Here's what credit card issuers actually do with the income number you give them. And this part is well documented in how credit approval actually works. When you apply for a card, your stated income becomes one input feeding into the algorithm that decides your credit limit. Depending on the issuer, it can also influence which interest rate tier you get offered. There's a federal law from 2009, generally called the Credit Card Act, which specifically requires issuers to consider your ability to pay before extending you credit. That's part of why income gets asked for on the application in the first place. That part is legitimate. That part is required. Here's the part that's genuinely worth knowing, though. What happens after you're approved? Multiple card issuers have stated openly in their own published terms that they generally don't independently verify the income you report. They ask for the number. They very rarely confirm it against an actual pay stub or tax document, the way a mortgage lender legally has to. Sit with that for a second. An institution wants a specific piece of information badly enough to build a recurring prompt into your app asking for it every few months, but not badly enough to ever check if it's accurate. That tells you something. The number isn't primarily being collected to verify risk, it's being collected to refine a profile. So, what's actually in that profile and what changes when you update it? The most well established use is credit limit adjustment. Issuers use income alongside your credit history, your utilization, and your payment behavior to periodically reassess how much credit to extend you. A higher stated income can support a higher limit offer. On the surface, that sounds purely good. More available credit, used responsibly, can actually help your credit utilization ratio and your score. But here's the honest part worth thinking through. A higher limit isn't just a number sitting unused in the background. It's an expanded boundary. And the data on consumer spending is pretty consistent here. Available credit and used credit tend to climb together over time for a meaningful share of cardholders. The increase isn't a reward with zero strings attached, it's a wider ceiling. And ceilings shape behavior whether anyone intends them to or not. The second documented use is targeted marketing. This one is openly disclosed in most card issuer privacy policies, if you ever actually read one, which almost nobody does. Once your income bracket is known, it becomes a segmentation tool. Premium cards with high annual fees get pitched to higher income brackets. Personal loan offers, balance transfer promotions, add-on insurance products, all get targeted using income combined with your existing spending and balance patterns. None of this requires a conspiracy theory. It's the same segmented marketing every retailer runs off your purchase history. The only difference is, most people don't picture their bank as a marketing engine the way they picture a store's email list. But functionally, the moment your income lands on file, that's exactly what it becomes an input for. Now, here's the genuinely important distinction. When you actually have to disclose income versus when it's optional. Mortgages, required by federal law. Full verification every single time? And that's a good thing, not a hassle. Auto loans, typically required, though how thoroughly it gets verified depends a lot on the lender and the loan size. Some check everything. Some lean heavily on the number you state, plus your credit score. New credit card applications, income is requested and genuinely used in the approval decision because of that ability to pay requirement we mentioned earlier. You do need to provide it accurately here. Putting false information on a credit application is fraud. That's a real legal line, and it should never get crossed for any reason. But a periodic income update request on an account you already hold, the pop-up asking you to refresh a number on a card that's already open, already approved, already working, that one is not legally required. You can close it. You can decline. Nothing happens to your existing account, your rate, or your credit score because you skipped updating a number on an account that already exists. That's the gap most people never clock. The pop-up looks exactly as urgent as a required field. It isn't one. So what's the actual takeaway here? Because this isn't about being paranoid toward your bank. It's about intentionality. That's the whole principle. When disclosure is legally required, mortgage applications, new credit applications, loan underwriting give accurate, complete information every time. That protects you. Lying on these forms carries real legal consequences, and it's never worth the risk. When disclosure is a voluntary update prompt on an account you already hold, decide based on what actually serves you. Want a higher credit limit and confident you'll manage it responsibly? Updating your income to support that request makes sense. Happy with your current limit and not interested in a profile that signals more marketing-friendly spending power? There's no rule saying you have to refresh that number every single time the app nudges you. The data doesn't vanish if you decline once. Your bank still sees your payment history, your utilization, how long you've held the account, all of which arguably say more about your actual financial behavior than a number typed into a box ever could. Declining to volunteer a fresh income figure doesn't make your account riskier in any real sense. It just means the bank has slightly less to work with when it's deciding how to market to you. That's not rebellion. That's just understanding what's actually required versus what's just being requested, and making the call that's genuinely yours to make. Here's what I want you to take from all of this. Most people fill out every single field on every form because forms feel mandatory even when they're not. The friendly tone, the pre-filled box, the gentle urgency, all of it is designed to make a voluntary request feel like a routine requirement. It isn't always one. Know which fields the law genuinely requires, and give those accurately every time because that part isn't optional and it shouldn't be. For everything else, the nudges, the refresh prompts, the income updates on accounts already working perfectly fine, make the decision based on what actually benefits you. That's not distrust. That's just finally reading the form correctly.